I'm ignoring you. All right, we are back. Here's where we left off. Let me do some things. All right. So we left off on the balance sheet, which is right here. We were looking at total liabilities. No, we were only doing assets. Now we need to do liabilities and equity. Let's look at the multiples. Market cap. We already know all this, so we really have a revolving credit line of nearly $2 billion. All right. Good to know. Capital structure details. Here we go. They owe $1.3 billion on convertible senior notes in 2 years. So nothing's due immediately, but these are convertible. Everything else is non-convertible. Thankfully, this is not their largest outstanding debt. That's really good. So good there. Ratios. This is just like all pre-calculated stuff. Segments. No, we're good. All right. So let's go back to the balance sheet. We're going to put this together in another chart. We're going to do another chart. All right. Another line chart action. Just a link. Yeah, we don't want that. Open source. Okay, so let's go back here. And we are going to do liabilities and equity as your title. Whoops, don't want to move it. Liabilities and equity. Our years are again 2019 to 2024. Oh, that was 2021 again. 2024. Okay. All right, what are we going to use? We are definitely going to do total current liabilities. I don't think anything else. Accrued expense. No, we can do total current, total common equity, or just total equity in general. Okay, so let's do total current liabilities, Total liabilities. We'll do additional paid in capital. Retained earnings. Again, they don't pay a dividend. And total equity. Total equity. All right. So let's. Wrong one. It's all right. We're good. Total current liabilities. Total liabilities. So. Boom. Boom. For the liabilities. Can't believe Control C and Control V are working on this Mac right now. I usually have to use the Windows icon on this keyboard. Okay. Got that. We got that. And that. All right. Unmake these, and then we're going to paste the format only. Okay. And then we're going to do the additional paid in capital. Let's actually currency rounded. Thank you. Additional and retained earnings here. Actually, let's just do these. Now, did I do total assets in here? I did. So I will also have to do total liabilities and equity. Liabilities and equity. Okay, so copy these over again. Retained earnings. And then total equity. Okay, let's suffocate those numbers. Format only. Format only. Then we have to bring this in, which is our liabilities and equity. Okay, let's get rid of that. Format only. Okay, bring them all in. We got total current, total liabilities. Oh, I need to change this to G. So additional paid-in capital, retained earnings, total equity, total liabilities and equity. We're going to put the legend on the bottom. Legends of the Hidden Temple. All right, so I just blew into the mic. I apologize. Total current liabilities. We're going to keep these blue. We're going to keep the liabilities blue. That's fine. We're going to do the equity as your orange and yellows. So let's do this. That one's a tough yellow. Let's do that. And we'll do... That's such a clusterfuck of shit. Your totals are going to be dashes as we did. Nope. And then total liabilities. We need to show the axis line. Okay. Put this here, and we're going to call this, wait, why am I not assets? Liabilities and equity, heading 4. Copy. No. There we go. All right. So one of the things that we need to point out is that the largest part of their liabilities is this long-term debt. And that's about 97% of their long-term debt. So roughly 97% of total liabilities is, what did we say it was, like 6 billion? Yeah, 6.5 billion is 6.5 6.5 billion in long-term debt. So we need to fix that first. Just make sure that we put it in million. Million. Update. Now, can I update these in the Google Sheet? We can. Google, Killing it, guys. Killing it. All right. Roughly 90 is long-term debt. So we can go back to our spreadsheet and look at their capital structure. So remember, we said there was $6 billion in long-term debt. 6.6 billion. Let's go back over here. Where was it? 6.5. So a lot of that other borrowing. So let's see. Bonds. Whoops. Depends when it was filed, but there you go. There's your debt. So they're company notes. There's no maturity on these or these convertible notes. Secured borrowing facilities. Most of the long-term debt are financial vehicles issued by the company, such as bonds and notes. What was it? Here. 1.3 billion. Of the long-term debt, 1.3 billion outstanding is due are convertible notes that mature in November 2026. Okay, we're gonna put a note here. I keep blowing in the mic. What the fuck is that about? Excuse my French. I do not like the fact that this company is heavily subsidized by debt. However, a lot of the debt that has been issued is based on the company's future earning potential, e.g. they are notes issued by the company. So I think it was a third is only revolving credit. Not even. Ooh, let's say 1.8 billion. $1.8 billion of the long-term debt can be traced back to revolving credit issued to the firm. So long as Affirm does not fall behind on their payments on the revolving credit line, and are able to make whole their outstanding debt to investors, the company will only become more and more appealing. Okay. So, lastly, we have our cash flow. It is 6:41 on this lovely Tuesday, election day. Let's go to cash flow. So the cash flow is not that long. I'm thinking this is going to be tomorrow thing. I know this is a short stream. We've only been going at it for 20 minutes, but it's all right. Slowly and steady. So tomorrow we will put together this the remaining cash flow, and then Thursday we will probably do a walkthrough of everything that we have. I don't think we need to go too much into the other financials of like really digging into their. Why is this not heavily subsidized by debt? I think we can change this back to a yellow. Heavily subsidized by debt of the most are notes held by investors priority over common stock holders. Okay, that's my fear right there. Preferred shares, bond holders, if the company were to go under, the common shareholders like me, like you, who invest in the common stock are not prioritized. But right now, I'm fairly certain, I feel comfortable that if shit did hit the fan, they could take another credit line out to cover that. But I don't think that they're at a point there, but that is yellow. It was red. If you followed along, it was red at one point in time. But regardless, I think tomorrow we will, like I said, we will do the cash flow document. And then Thursday we'll do a full read through. And we'll kind of go over everything that we saw. And at first I thought we were going to have to go through all those paperwork stating what they've invested in, but I don't really want to do that for this company because I think we can investigate other and bigger things, better things, more exciting things. Chainlink, for example. If you don't know, now you know. But thanks for tuning in. Eventually, maybe, someday, maybe this will be out there. It will be out there. Maybe you'll see it. So yeah, thanks for tuning in. Pear out.